end of the year is quickly approaching, and now is a good time to take a closer look at what rates you should take into 2025. The rate sector has experienced an impressive rally over the past year, pushing some of them in overvalued category. And in today's video, I'm going to highlight three popular rates that I would consider selling because they offer little remaining upside at this point. Hey, this is Jussi. I'm from a small investment firm that specializes in rate investing, and the first rate that I would consider selling is called Tanger, ticker symbol SKT. Tanger has kept rising a lot higher than I would have expected and now trades even higher than before the pandemic. To be fair, retail real estate is today doing really well. It's a great inflation hedge, and the high inflation of recent years has allowed REITs like SQT to bump up their rents to much higher levels. Moreover, this growth should continue in the coming years because unlike other property sectors that were hit with oversupply, retail has attracted very few developers in comparison, resulting in strong supply-demand dynamics that should continue in the coming years. But my issue with Tanger is that it owns mostly outlet centers, and I expect those to suffer over the long run from the growth of e-commerce sites like Amazon and also from the growth of discount retailers like TJ Maxx. High quality malls like those of Simon Property Groups are much better positioned, in my opinion, because they're well located and diversified by use with significant retail, entertainment, and non-retail components that makes them more resilient to the growth of e-commerce. When you think of outlet centers, they are typically in more remote locations, they require a longer car drive, and they focus more on fashion and accessories, and they pull in consumers by offering lower prices. But in today's world, I fear that competing on pricing is not enough anymore because Amazon and other sites can offer comparable prices with even more convenience. You now have 1 day shipping, and so why would you drive 45 minutes to get to your next outlet center? This does not mean that outlet centers are going to die anytime soon. On the contrary, they will likely keep producing steady cash flow for many years to come, but this is not a growth sector, and I wouldn't pay 17 times FFO for Tanger. Remember, these properties also require quite a bit of capex, so it's actually trading at over 20 times AFFO at the moment. If I wanted to invest in retail, I think that there are much better opportunities. One of them is called Ryokan, which today trades at 10 times FFO, and in my opinion, on superior properties, those are mostly service-oriented strip centers in growing cities like Toronto. So for these reasons, I would consider selling Tanger if I owned it today. Now, the second REIT I would also consider selling is called Welltower. Welltower is the biggest healthcare REIT in the world. We bought it at High Yield Landlord following the pandemic crash, predicting that senior housing business would strongly recover, and this thesis has now played out. The REIT's cash flow is growing at a very rapid pace and the market loves it. But the issue here is that the share price has bounced back very strongly and now trades at near all-time highs. Therefore, I think that the growth is now priced into the stock already, and this rapid growth won't continue forever. That's because we think that the strong performance will almost certainly attract a lot of new developers into the sector, likely leading to another cycle of oversupply sometime in the next 3 to 5 years. So yes, the rapid growth will likely continue for another few years, but I think that this is now priced into the stock with the high valuation. It's currently trading at 30 times FFO, and so there's little upside left. We did really well with Welltower. We sold our position with very large gain, and we're able to reinvest these proceeds into a better opportunity. If you want to access my full portfolio, you can do so by joining High Yield Landlord for a 2-week free trial. First link in the description of this video. Then the third REIT I would consider selling is called Extra Space Storage. Its ticker symbol is EXR. This is the leader in self-storage in the US and has enjoyed an impressive rally over the past 14 months, surging by about 40% and significantly outperforming the rest of the REIT sector. As a result, it now trades at 17 times FFO, which is not a historically high multiple for the REITs. On the contrary, EXR has commonly traded at over 20 times in the past, but that doesn't make it a buy. The issue facing Extra Space Storage and other self-storage REITs like Public Storage is that we think that self-storage is now overbuilt in the US, and this could lead to stagnating cash flow for many years to come. The pandemic first led to a boom in demand because people are moving a lot, they want to make space for a home office, and unfortunately, a lot of older generations passed away and left a lot of stuff behind. But this booming demand then fueled a boom in new construction activity as real estate developers start to capitalize on this growing demand. And what made it even worse is that interest rates were very low and capital was abandoned. Now these development projects are gradually hitting the market right as the demand for self-storage is also normalizing. Increasingly, many people are now returning to the office and have less use for a home office. Then the vaccine is also reducing COVID-related death. And then finally, people are also moving less, especially since interest rates are so high and housing is unaffordable. More supply coupled with less demand, and you have a perfect recipe for declining rents and lower occupancy rates. And so with that in mind, extra space storage really isn't that cheap. Typically, REITs that struggle with such oversupply are priced at much lower valuation multiples. A good example here is Alexandria Real Estate, which today trades at just 12 times FFO because life science space is oversupplied. Yet extra space storage still trades at 17 times FFO, I think it's slightly overpriced, and for this reason, I wouldn't buy it today. These three REITs are good examples of what I mean when I say that not all REITs are worth buying. The recent REIT market rally was very uneven, with some rising far more than others. And for this reason, we think that now is a great time to review your holdings and do some portfolio recycling. And with that in mind, we've recently sold a few of our holdings at High Yield Landlord and reinvested the proceeds in better opportunities. As I said earlier, you can access our full portfolio and all our trade alerts in real time by joining us for a 2-week free trial at High Yield Landlord. In case you want to check it out, it will be the first link in the description of this video. Now let me know in the comment section below what other REITs you would consider selling going into 2025. Thanks so much for your interest, and see you at my next one. Bye bye.